Welcome to the Monocle Banking Podcast, a series curated by Monocle Solutions where we balance the books in the dynamic world of finance. I'm your host, Michael Avery, as always, steering you through the ever-shifting story of banking and insurance in this series. Well, South African banks' headline earnings grew 13.8% last year, despite what can only be termed a very challenging operating environment and the complex macroeconomics of load shedding, rising interest rates, and consumers under increasing stress. We see PwC Southern Africa looking at the state of banks in its annual SA banking report called the Major Banks Analysis, and it examined the results of ABSA, FirstRand, Nedbank and Standard Bank, and it showed that our banks are really in fine fettle. Combined headline earnings growth of 13.8% versus 2022 and a combined return on equity of 17.6%, an increase from 17.1% in the prior year as well. Worryingly, though, the credit loss ratio of these banks is rising, and that rose to 102 basis points from 82 bips in 2022. Well, my guest this week is Riviaan Roopnarain, who's a PwC South Africa Banking and Capital Markets Partner. Riviaan, welcome to the podcast.
It's a pleasure to be with you, Michael, and thank you for having me.
Now, given all of the complexities that our local banks have had to steer through, low growth locally, managing foreign currency risks as they expand into the rest of Africa, how have South African banks adjusted their strategic priorities in response to the evolving conditions that they've been confronted by over the last 12 months?
Yeah, Michael, you would have noticed that when we thought about a title for this round of our Banks Analysis publication, we settled on solid foundations, challenging conditions. And we think that that appropriately frames this reporting period and this set of results, which, as you mentioned, has been fraught with a number of challenges in South Africa. But also, if you look at the rest of the continent where a lot of these banks operate, and in some cases at scale, they've had to navigate some of the challenges in Africa as well. Michael, what we see with this set of results is that South Africa's major banks are familiar with navigating uncertain conditions. They deal with volatility very well. And through their experience of the management teams, which have largely been stable over a number of years, they model for various scenarios and various outcomes. And what you see in this set of results is the outcome of positioning their balance sheet strategically, operationally, in order to deal with the various challenges that they navigated in this period. And in doing so, we think they've produced a great set of results.
Can you give a few examples of initiatives or decisions made by banks to strengthen their foundations amidst all of these challenges?
Certainly. So if we start with credit, which is an area perennially that bank management teams are focused on, what you found in this period is that credit impairment charges increased by around 27% compared to 2022. There's a combination of factors driving that, and it differs between whether you're looking at the retail loan portfolio, the corporate loan portfolio, or the commercial loan portfolio. But one of the common factors underneath each of these has been the rise in interest rates in South Africa, and indeed in various of the economies where the banks operate. Those interest rates, as we know, increased on the back of elevated levels of inflation. And a good example of how banks have dealt with this is they factored in the interest rate outlook long before the interest rate increases actually manifested and were determined by the central bank. So you saw that play out in terms of how they adjust risk appetite levels in certain portfolios. For example, in residential mortgages in South Africa, where you saw application rates decline towards the end of 2023 on the back of this higher interest rate environment, the banks adjusted their risk appetite and focused on other types of lending portfolios. So that's one example. Another example is on cost management. I think faced with the elevated inflation context, banks knew that they had to manage costs and manage them quite carefully and quite diligently. So they focused their attention on making sure where there was spend, it was in areas that positioned them in line with their strategic objectives. For example, focusing on continuing to digitize their IT infrastructure, their IT estate, because they are aware of the fact that in doing so, you enhance the customer experience and at the same time, you focus your spend in the right areas that take you forward while cutting back on a lot of areas of discretionary spend. So those are some of the examples, Michael, in a volatile and complex period.
Specifically on digital, it is one area that through the results period, chatting to the various CEOs, they continue to spend well in excess in terms of inflation on improving their digital offerings, building out their IT systems. And in many ways, the conversations around dealing with the legacy issues in banks have started to fade into the background. I recall a time 5 years ago, just prior to COVID, where it was still one of the dominant themes. The banks were really dealing with the spaghetti IT systems that had been built from the 80s and COBOL and then stacked with new technology. And I think Nedbank was one of the first to kind of rip and replace everything and shift it into the cloud. Where would you say the banks are in terms of that digital maturity journey? How far are they into fully maturing into fully fledged digital organizations?
Michael, I think it differs based on individual institutions, but generally what I would say is that it's been quite clear over the last few years that all of the banks together have recognized the need for evolving their IT estates, digitizing their operations. And a big part of what's driven that journey is evolving customer expectations, as well as technological trends globally. The banks have come to realize that the way in which they engage with their customers from a channel perspective is different to what it was even just a decade ago. A lot of primary banking activity today happens via the mobile app, happens via online banking channels. And in order to offer customers that fully digitized experience, you've got to make sure that the back-end systems, the infrastructure that powers what the customer sees on the front end, to a large extent is cloud-based and is digital. And that's really been the journey that they've been on for the last several years. What you've heard in this results period is that they continue to focus on leveraging emerging technology. Technology doesn't stand still, as we know, and they continue to make sure that they focus on this area because it's what gives them strategic advantage, it's what makes them more efficient internally, and ultimately it's what their customers require. So they're very attuned, to the shift in customer behavior, Michael.
Coming back now to the balance sheet growth that we've seen across both loans and deposits, and it continues to be a standout feature at record levels. What do you see as driving this growth in what is effectively an ex-growth economy?
So if we start with the funding side or deposits, it is quite remarkable to see deposits growing at the rate that it has in what is an economy that is coming under considerable stress in 2023 and indeed 2024 so far. One of the ways the banks have been able to grow their deposit bases, Michael, is simply by making it easier for customers to place deposits with them and just overall making their deposit-taking activities easier. The way in which you can transfer funds between accounts, the way in which you can open an account have all become incrementally easier than just a few years ago. And that just makes deposit-taking activity a lot easier from a retail perspective. On the other hand, you see pricing competition, particularly in retail banking, where banks are aware of the interest rate environment. They are pricing deposit interest rates competitively. And that's driven not just by the major banks, but also new and emerging players. And that's another avenue in which you can attract deposits by offering good quality interest rates in what is a high interest rate environment. So that's on the deposit side from a retail perspective. From a corporate banking perspective, I think it's probably fair to say there may still be a bit of a liquidity overhang from the COVID period when there was various forms of relief provided. So that's still playing its role in the market. And then if we move to the lending side, again, I think the banks have, yes, gross loans and advances have grown in total. But if you look at individual portfolios, what is driving the growth for each of the banks respectively is quite attuned to their strategic areas of focus. When one bank focuses on a particular geography in a particular product sector, another bank is focused differently. But generally, on the whole, what we would say is that you do see a decline in loan portfolios that are very interest rate sensitive, things like vehicle and asset financing, things like home loans. On the other hand, you see strong growth in other types of structured loan products. So it is quite a different story depending on the institution, but I think the themes hold. There's clearly balance sheet growth overall.
And given that we're probably in the really late stage of this interest rate hiking cycle, many expecting interest rates to start coming down towards the end of next quarter. So we're looking at Q3. That's certainly the market expectation for the Fed, the June announcement. The Reserve Bank here in South Africa tends to follow in lockstep to some extent, given inflation remains under control here. So what do you see as the key consideration for banks in sustaining balance sheet growth while managing elevated credit risks, particularly in those sensitive portfolios that you mentioned, like home loans and personal finance?
Michael, I think our banking management teams are very well aware of the relationship between interest rates and the interest rate cycle and how that translates into credit impairments, risk appetite, and indeed interest income, which saw an advantage from the high interest rate environment over 2023. So you hear them messaging to the market in their results presentation that there is quite a bit of uncertainty in 2024 on the revenue side, because if interest rates fall, the ability to generate revenues out of those loan portfolios reduces. On the other hand, there's an expectation that credit impairments will probably fall over time as interest rates come down and as pressure on household and business balance sheets decrease. So there is that interplay between revenue and credit impairment charges. They have been modeling various scenarios. I think they are particularly mindful. 2024 is a significant election year, not just in South Africa, but indeed globally, where roughly half the world's population is in an election year. And in an election year, there are elevated levels of uncertainty around a range of economic variables, including interest rates. So they will be modeling these scenarios, modeling the different variable outcomes, and positioning their balance sheets accordingly, mindful of the fact that 2024 is probably a particularly complex year, given elections, given the interest rate cycle in South Africa and in their markets of operation.
Yeah, it's a tricky balancing act this year in particular, given the geopolitical uncertainty that all of these elections throw into the mix. We see it in the US. It's another close run thing between Trump and Biden. If you look at the polls so far, I mean, the polls have the ANC. I was looking at a note from Mergent's investment managers this week saying they're modeling the ANC based on the various polling that's been done so far, which can obviously still change quite a lot from now until the end of May. But the ANC, if everyone went out to vote tomorrow, would probably get around the mid-40s. What does that mean for coalitions? What does it mean for various economic policies and the like? At least we've seen from a regulatory perspective some stability in terms of the reappointment of the SARB governor, Lesetja Kganyago. Can you just talk to me about how banks collaborate here when we talk about that kind of stability with the various regulatory bodies and their industry peers, just to enhance their risk management capabilities in such a dynamic environment that we're currently operating in?
Michael, I think it's important to remember that in South Africa, we've got a banking prudential regulator in the form of the Prudential Authority at the SARB, as well as a conduct regulator, the FSCA, both of which are very well regarded internationally, who are members of international bodies that set banking regulations. And amidst all the uncertainty that we've been talking about around 2024, from an economic and political perspective, we've got quite a bit of stability in terms of our regulatory landscape. Our banking regulators have prided themselves on stability and policy certainty. They align to international standards with very few national discretions or departures. And that has translated to, I think, consistently over time, one of the reasons why our banks are well capitalized, liquid, and well regarded in international capital markets. So I think in spite of all the uncertainty, you've got a regulatory framework in South Africa that is widely recognized, positively so, and will bring a level of stability to the financial system in 2024.
When we look at one of the positives out of, let's take Standard Bank's results, for example, it has been the growth that Standard Bank and many other banks have also seen outside of South Africa, pushing into Africa, Standard Bank obviously being the biggest in terms of its geographic and earnings profile. But what are the challenges that are being faced by banks in operating across diverse African territories? And currency risk certainly has got to be right up there. I think there was a flagging in the most recent results that currency headwinds actually could prove to be a bit of a headwind on earnings for Standard Bank. Broadly speaking, how are banks managing their push into Africa?
Michael, I think it's fair to say that economic growth rates outside of South Africa in the rest of sub-Saharan Africa has been more favorable than South Africa. So you see the ability to capture opportunities in some of these African countries outside of South Africa to a greater extent than South Africa. And you see that play out in terms of the earnings contribution from their rest of African operations to their group results. At the same time, as we saw in 2023, is that the African continent and many of the economies within it have got nuanced risks, volatile currencies, debt sustainability issues, and overall elevated levels of sovereign risk in certain jurisdictions. So the banks have had to navigate these scenarios. What it means from a risk management perspective, first of all, is in credit. If sovereign risk goes up, Bear in mind, for regulatory rules, banks have got to hold sovereign assets, so government bonds and treasury bills on their balance sheets. The credit provisions associated with that will increase, but they are factoring this into their modeling scenarios. I think from an opportunity perspective, there is quite a lot of infrastructure development, sustainable financing opportunities on the African continent. And I think on the whole, our major banks believe that they are well positioned to capture some of those opportunities, while at the same time being mindful of navigating some of the elevated risks that Africa has shown itself to produce in 2023.
Yeah, again, it's one of those very tricky situations because you want to capture that growth in the new markets, but it does come with those risks, specifically from a regulatory perspective, as you said, in holding that capital. Costs, if you look at it, inflation was at the upper end of the SARB's band of 3 to 6% for most of the year. But still, if you look at the cost increase, 12.6% against 2022, the primary contributors remaining staff costs and then obviously investments, as we mentioned earlier, in technology. So, if you look at that cost line, it's growing at more than double inflation. How do banks prioritize their investment in talent retention and technology while trying to at least contain costs to some extent?
Yeah, I think the first thing to mention is you're quite right, operating expenses growing at double inflation. But if you look at revenue in total, that's growing marginally faster than costs. So I think the banks will tell you that they are spending in areas to generate revenue. So you get this positive operating leverage, or as they refer to it, positive jaws. Where they are spending in some of the areas that you mentioned, talent retention, in some cases reskilling talent to play different roles in the organization, I think they get the benefit of that probably over time. But a lot of the expenditure has been driven by investments in information technology, bearing in mind that some of these suppliers are foreign, and therefore you've got the translation effects of a weaker currency when you've got to pay some of these invoices in dollars. But on the whole, I think it's important to bear in mind the cost to income ratio is probably now at its lowest level for these four banks combined that we've seen in South Africa at 52.2%. And they are trending towards that 50% cost to income ratio, which many of them have spoken about in recent periods. So there's two levers. You've got to manage your spend, being aware of being in an inflationary environment, spend in a disciplined manner, but at the same time not compromising investments. And that's offset to a large extent by making sure revenue generating activities are appropriate. And I think that's what we see in this set of results.
So if you're spending to grow, then at least you're spending in the right areas. And it's probably one way that banks measure the ROI of their investments in talent and tech. How do they ensure alignment, though, with their long-term strategic objectives? Because the ROI on those kinds of investments tends to be in cycles often beyond even existing management teams.
Correct. And you'll remember probably 2 or 3 years ago, Michael, I think all four of these banks that are in the scope of our analysis put out their medium-term strategic plans, in some cases up to 2025 or 2027. And it was in those plans where they spoke about some of the longer-term measurement metrics like ROI. And if we listen to them in the latest reporting period, or indeed the half year at last year for some of them, they consistently have indicated that they track those measurement metrics that they put out a few years ago, and in some cases have either met them fully or are on track to meet them. So I think it's fair to say this is on the minds of bank management teams. They are managing for the long term, not just for the short term. And what you see in the 2023 set of results is probably the shorter term effects of the economic environment, the benefit of higher interest rates on net interest income. But it's quite clear, particularly as you listen to how they talk about the 2024 outlook, they are thinking about the longer term management metrics, and they indicate that they are on track towards meeting them.
And given that medium to longer term time horizon, one of the big talking points over the last 12 months has been artificial intelligence, AI. A lot of it's hype. I've got to say, I saw AI on an electric toothbrush brand the other day, and I thought, well, have we reached peak AI? A lot of it is real value. I think the banks were very early into the tech conversation around robotic process automation, for example. Some were early adopters of bots in chat form, which weren't quite as effective as probably what we see today, and probably some fingers burnt there. So how are banks incorporating generative AI into their strategic planning processes?
Michael, our sense is that the adoption of generative AI in banking has been deliberate and careful, and I think for good reason. Banks are highly regulated institutions. They are in possession of sensitive data from customers. And so they've been adding generative AI to their model governance processes in a fairly measured fashion. Having said that, there are many use cases that they deploy generative AI technologies within the institutions, things like credit granting, things like treasury management, the front end of engaging with the more basic customer queries. So it is there, but I think most banks will probably tell you they probably see themselves as fast followers in this regard, as opposed to driving it because of that regulated nature and risk cautious nature that banks typically adopt, certainly our major banks in South Africa.
And sticking with the medium to long-term plans, climate change and climate finance have been sort of buzzwords and hot topics, but we certainly see things like green bonds, sustainable sukuks coming into the market, the way banks are looking through their books at not only their own scope 1 and 2 emissions, but scope 3 emissions into who they lend to. It's still a very nascent and emerging area of finance. How do you think South Africa's banks are grappling with the challenges that come with climate change?
I think it's certainly on the mind of management teams, Michael. And look, the first thing to mention is that they've got the capital and the resources to invest. If we look at the shape of their balance sheets, certainly for this reporting period, I think they recognize that there are opportunities from sustainable financing initiatives to alleviating concerns with some of the high carbon economies in Africa. And they see themselves as being able to play a meaningful role to support Africa's economic and population growth expectations. At the same time, climate change is a very societally aware issue, both on the part of society at large and corporate society. And so they have to measure that against the expectations of society, trying to make sure their own carbon footprints are managed effectively. And most of them, if not all of them, have put out measurement metrics that they are holding themselves to. And I think in time, we will see a lot more reporting publicly, not just on financial metrics like we see now, but on some of these climate-related metrics, because they understand the importance of managing themselves in what is clearly a dynamic and fast-moving area.
If you just look at the conversation in Europe and the US, for example, which is slightly more advanced, there's talk of further sterilizing capital or some kind of punitive holding cost for capital that would penalize lending into fossil fuels, for example. And one wonders how that might be approached in a developing market context like South Africa's, where we've still got a very carbon intensive economy. And it's an area that we certainly follow with great interest. IFRS 17 was also the big accounting change that happened in 2023. It's a new standard dealing with the measurement of insurance contracts, which required the restatement of results. What were the most significant impacts of this change in IFRS 17?
Yeah, so IFRS 17, Michael, is a new standard that came into effect for the first time for the reporting period ended December 23. It deals with insurers primarily, but it also deals with products that banks typically have, like bank assurance, which have insurance contract elements. And the 4 banks that we cover in this analysis all have got insurance subsidiaries of different sizes. So IFRS 17 was applicable and relevant to all of them. What we saw is that the impact of the standard in quantitative terms was probably limited. So if you look at the impact of those restatements on the net asset values, it was probably not material in the context of their balance sheet sizes. Having said that, IFRS 17 was quite operationally intensive to implement. Insurance accounting is complex. It requires very granular levels of data, and it requires very sophisticated modeling techniques. So to stand all of that up in the calendar year 2023 was a focus for management teams, but they have done that. They have implemented IFRS 17. The impact in quantitative terms, as I say, was probably limited, but the operational effort to implement the standard was probably far more significant. Going forward, they will continue to apply IFRS 17 and report accordingly. But the effects will, I think we've seen the most significant parts of it now in the restated results.
Right. Demanding a lot of time, but ultimately very little impact for shareholders and beyond those who are absolute accounting nerds to really get too excited about IFRS 17. Just looking ahead, obviously we've discussed a lot of the uncertainty for the outlook given what's playing out in the political economy in particular, and also just how sticky inflation is actually proving to be. I still am of the opinion the market might be underestimating that and maybe a little bit too bullish on when the Fed will start cutting rates, but just shows you how difficult it is to try and forecast these things. So I'm sure the management teams of the big banks are going to be prudent, as they always are. What do you think the key focus areas for banks is going to be in terms of capital allocation, in terms of risk management, and their continuity planning for the year ahead?
Michael, I think that certainly our view, and it was expressed and shared by many of the management teams in their results releases, is that 2024 appears to be on track to be a year of considerable complexity and uncertainty. And I think that is well understood. There is a high correlation between bank financial results and the GDP of the economies in which they operate. And it appears that 2024 is set to be a low growth period for South Africa, given our structural constraints, but also in several of the economies in which they operate. So you can imagine, therefore, that their focus in 2024, what will be occupying the minds of bank management teams, will be navigating this uncertain and complex environment. Fortunately, that is something bank management teams do day in and day out. I think replicating the base effects of their 2023 performance will be an area of focus. They will probably be making sure risk appetite is adjusted to the interest rate cycle and how that plays out over the course of the year. Cost management, we expect to continue to be a very heightened focus, not just because of the elevated inflation environment, but because it's been a strategic focus area for banks for several years now. And then just managing customer experience and enhancing, digitizing, evolving to the needs of customers. I think these things will continue to be focus areas for our bank management teams.
And Riviaan, I've got to ask you, because we've got two veteran CEOs standing down in the form of Mike Brown at Nedbank and Alan Pullinger at FirstRand. We've got Mary Vilakazi coming up on the podcast in April. Really looking forward to chatting to her. But as we reflect on their tenures as CEOs of Nedbank and FirstRand, what do you think the legacy is that they leave behind? And what does it also indicate to you about the succession planning in South Africa's big banks?
Michael, I think both CEOs have made an enormous contribution to the banking industry in South Africa and globally over a lengthy period. We acknowledge them in our press release. I think what stood out for me in this succession cycle is that if you look at the executive changes that have occurred in South Africa's major banks, it is heartening to some extent that the changes have come from within the industry, in some cases, in many cases actually, within the organizations themselves. So that speaks to the depth and quality of the talent pool in South African banking. And these individuals have commented on that very depth and quality of their people themselves. So it's clear that South African banking talent exists, is deep, is recognizable, and can deal with change at the executive level fairly seamlessly.
Well, that's where we're going to have to leave it. Riviaan Roopnarain, thank you very much. PwC South Africa Banking and Capital Markets Partner. It's been a great pleasure having you on the podcast talking about what is, again, another really resilient and responsive performance by South Africa's banks. Take care.
Much appreciated.
And that wraps up this week's episode of the Monocle Banking Podcast. Before we go, I'd like to extend our continued gratitude to our growing audience for tuning in. Remember, share the content, like, subscribe, and we'll see you next week for more on the Monocle Banking Podcast. Cheers.